You're likely familiar with the term down payment. A buyer is expected to make a down payment when purchasing a house. Putting down 20% has long been the golden rule when buying a home. But it might feel unattainable for a first-time home buyer. The money you pay directly towards purchasing the house is a big deal, but it's not a deal breaker. In the last few years, I have connected my clients with lenders that help them with down payment assistance. DP programs can be a lifeline for aspiring home buyers ready to unlock the door to home ownership, wealth, and stability. If this is your first time here, please subscribe. Click on that like button and share. Remember in my last video, I stated that there are different programs and each one has its own criteria like income requirement, good credit score, or the need to buy a house in a specific location. Secondly, I mentioned that you need to understand each program, whether it's a grant or a forgivable loan, whether there are repayment terms, or whether there are limitations on selling the house within a time frame. A qualified lender can answer all of these questions and recommend the program that best meets your needs. One popular DPA lenders recommend is Chenoa Fund. This program has no income limitation or restrictions. So whether you make $70,000 or $200,000, you can be eligible as long as the price of the home fits into the FHA loan limit in the area you're looking to buy. It uses only the mortgage applicant's information, so your spouse or your children will not be bothered, and it does not require additional underwriting. You will need a minimum credit score of about 600 to qualify for 3.5% assistance, or a higher credit score to qualify for 5%. Some of my clients have the money, but they don't want to spend it on down payments or closing costs. So they prefer the 5% DPA because that way they can use 3.5% towards the down payment and the 1.5% towards closing costs. Thereby, they save money and focus on other needs, including additional expenses, appraisal, inspections, and origination fees. Another important thing is that you will have two liens when you use a DPA with your mortgage. The first lien is the 96.5% on your loan, and the second lien is the one on the DPA, in this case, the Chenoa Fund. If you pay your mortgage on time for 3 years, the 3.5% DPA will be forgiven. And if you get the 5% DPA, you have to pay on time for 10 years. If you refinance or sell before those years, you must pay it back. Lastly, Chenoa typically has a higher interest rate compared with other DPAs, but its pros of accepting conventional loans, using mortgage applicants' information only, having a 600 credit score, and having no income limit makes it a preferred DPA program for some lenders and qualified buyers. For further details or a no obligation consultation, please click on the link in the description. And if you find this video helpful, please smash the like button, subscribe, and join me on the next video. Until then, happy house hunting.